Our next speaker is Steve Roman. He's Chairman, President, CEO of Global Atomic. So, Stephen, why don't you take it away?
Thank you, David, and thank you, Red Cloud, for inviting me today. Gracie, you're going to be moving my slides, so if you could go to the next slide. We're not in the United States. We actually, next slide, please. Have two divisions, the uranium and the zinc. So we actually produce cash flow from our zinc operation, and that's funded a lot of our uranium development without diluting shareholders. So we produce a high-grade zinc oxide concentrate, and we sell to smelters in Europe. Glencore is our biggest customer there. We've got 4 uranium projects in Niger. With the DASA we'll speak about today is the one that's fully permitted and moving forward. Next slide. So we're in an area called the Timber Soy Basin. So this is an area similar to Athabasca's Athabasca Basin, or Saskatchewan, sorry. And this is where uranium's been produced in Niger for the last 50 years. France has had 2 operating mines there, Cominac and Somer. Cominac recently shut after 50 years of operation. Somer is still running, and we're working on a direct shipping ore agreement with Orano as we speak. There's a number of other projects there in the basin. The great thing about it is that because uranium mining has been going on here for so long, there's good infrastructure, there's power, there's water, there's labor available, so it's a great place to explore and develop a uranium project. Next slide. So this is a longitudinal section cartoon of our DASA project. So what we've done is we've, based on the uranium price being down in the dumps, so to speak, for so many years, we used a very high cutoff grade to do our feasibility study, which was done at $35 a pound. And we defined an initial mining area we call the flank zone. You see there is the phase 1 box around that area close to surface. And the idea being that we will mine at 1,000 tons per day. So not a big mining operation. That keeps our CapEx exposure down considerably. And we produce about 4.5 million pounds a year. As we complete mining that area, which is about a 12-year mine life, we move seamlessly into phase 2, which is at the bulk of the underground material, and then eventually mining lower grade open pit. So this is a 250 million pound deposit. As it sits now, it's still open on strike and down dip, so it could get bigger, but we had sufficient uranium here to kick things off, get our mining permit, our environmental permit, and actually we're in construction mode right now. Next slide. So this is a view of measured, indicated, and inferred resources at DASA. And right now that central block of yellow there, that's an inferred. We've now completed drilling on that, and we'll be moving that up into the measured indicated category and actually wrapping a new mine plan around that sometime towards the end of the year. So we feel that that'll allow us to mine a lot longer than 12 years in the flank zone area, and of course reduce our overall underground development costs. So that should keep us a very low cost producer. Next slide. So you can see here how that drilling has turned zone 2A, 2B, and zone 3, those smaller dark black sort of areas, into a much larger area that we will be incorporating into the new mine plan by the year end. We're now drilling in zone 4 and zone 5. The reason these zones are in the overall picture is that they had enough drilling done on them that when we did our mine plan, they got pulled into the mine model, and they made the cut, so to speak, based on our cutoff grade of just over 2,000 ppm that we used for the cutoff. So on the next slide, I think you'll see some economics here. No, that's a grade tonnage report. So really, no, go back up, Gracie, thanks. So just here, most African projects use about 200 to 300 ppm as a cutoff grade. We used, as I mentioned, about 2,000 ppm. That shows you that our head grade, even at 2,500 ppm cutoff, is about 0.75%, and we've got 110 million pounds of that grade. If uranium prices ever went down again to some historic lows, well, we would raise the cutoff grade. You can see at a 10,000 ppm cutoff, we've got over 50 million pounds running at about 2%. So this is a project that's similar to a high-grade Saskatchewan Athabasca project, but it's located in Africa and it's fully permitted. Now you can go to the next one. So that little flank zone area, that red box that we saw earlier, that'll kick out about 45 million pounds at just over 0.5%. And you'll see the capex there just over 200 million, all in sustaining cost at 21.93. That gives us an after-tax NPV at $35 of 157 million and 22.7 IRR. Again, that's only on that starter mine. That's that flank zone area. We figure it represents about 20% of the overall deposit. If you go to the next slide, you will see some sensitivities. Currently, let's say round numbers, we're around $50 a pound currently. So you can see what happens to the numbers at 50. A lot of our shareholders asked us to show $100 a pound. Of course, the last big uranium spike in 2007 went to about $136 a pound. But at 100, we're 1.5 billion after tax with 100% IRR. We're hoping it'll get there, but nevertheless, right now we're a very economic project at current prices. Next slide. So this is our production profile with a little bit of production coming on late 24 and then leveling out in an average about 4.5 million as the dark bars are phase 1, and then we move seamlessly into phase 2 and maintain about that 4.5 million pound production rate. We felt that was a good sweet spot to be in, something we could sell. We are starting now. We've announced an offtake agreement with a major North American utility, and there's more I expect to happen this year. Next slide. So this little chronology from the time we signed our mining agreements in Niger. We actually entered the country in 2005 when they were opening the country for new foreign investment. And we spent 2 years researching old historic records, picked 6 areas. We've got 4 deposits now. We view the DASA as sort of a centralized, as you call it, hub and spoke, where we'd build the mill there and then we'd be able to feed it from a couple of other operations as we move them ahead. 2017, we went public through the merger with our zinc operation, a company we started as well in 2005. And that's provided us a lot of solid cash flow going forward. We merged with that operation. We also signed an agreement with Orano to direct ship ore. So it gives us some flexibility in that if the mill financing or anything is delayed on the mill, we can start generating cash flow by the end of 2024 with direct shipments. I won't stand on this slide, so we'll go to the next one. And a lot of work going on. The idea here is to continue mining, ramping, and building the plant starting next year. We will be collaring the portal in November. We've already completed the box cut. We're putting all the mine camp and surface facilities on site now, commission the plant in 2024 and begin yellowcake shipments in 2025. Next slide. Niger, long history in uranium mining, very well established, good infrastructure, very trained workforce, and with Cominac recently shutting down, we have a lot of very skilled people right in our area. Next slide, that's a shot of Niamey downtown with the Mines Ministry building. This is our DASA camp. Back in the early days, it's much bigger now. It's flat, open ground there. Looks a little bit like Texas. We've been big on the ESG. I won't be reading through all this, but we supply food, drill water wells for local communities. We view this project as going to be green with a lot of electrification, battery, solar. Next one. We will be, a little bit on Iskenderian. Keep going, please. That's a shot of our plant in Turkey. So that's right on the ocean, the Mediterranean. And we ship from our own port facility to Europe, and Glencore is our big customer. We produce a 70% zinc oxide con by reprocessing waste from steel mills. Next slide. I won't dwell on that. Just in 2019, we knocked the old plant down, built a new one. You've got 1 quarter there for 2022. We're running at about 70% capacity throughput right now because of COVID. All the steel business was depressed for the last couple of years, but we're very profitable. Next slide. Uranium, I don't need to dwell on that. Everybody knows about the market. Next one. A little bit, we've got 177 million shares out, about $500 million Canadian market cap, and a lot of good institutional support that's come in the last year or two. Next one. Solid board of directors. I won't dwell there. Dave's kicking me here, so I better move. Next slide, please. Management team, all of these groups and these people we've built up over the last number of years as we continue to advance the project. All very solid people. This is all on our website. Next one. So just to recap, we're a fully permitted uranium project with the mine currently under development. Established cash flow, tight share structure, and we're very happy to be in this new uranium renaissance. And finally, after 17 years in Niger, moving this project into production. Thank you.
Thank you, Stephen.